This week on Wealth Track, with investors cascading out of bonds, is this the right time to launch a new bond fund? Top-rated manager Kathleen Gaffney guides investors to income sources in her new Eaton Vance bond fund. Keeping your bond portfolio afloat is next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This has not been a fun time to be a bond investor or a fixed income manager. Investors have been freaking out ever since May, when Federal Reserve Chairman Ben Bernanke suggested the Fed might start reducing or tapering its massive $85 billion worth of monthly bond purchases. Even a hint of diminished government support for the Treasury and mortgage bond markets have sent interest rates higher and bond prices lower. Investors across the country are taking action to avoid feeling any more pain. According to Morningstar, they have been selling even the most successful bond funds. The world's largest mutual fund, PIMCO's Total Return Fund, run by famed bond guru Bill Gross, lost more than 14% of its assets, or $41 billion worth, in a recent 4-month period. Redemptions and price declines have also hit legendary fund manager Dan Fuss at the Lumen Sales Bond Fund. Recent guest portfolio strategist Francois Trahan points out that rates are rising in many places around the world, regardless of policy, because either economies are improving, as in the U.S., or governments are tightening to fight inflation, as they are doing in many emerging markets. With bond markets under stress, is this any time to launch a bond fund? Well, that is what today's guest has done. She is Kathleen Gaffney, founding lead portfolio manager of the recently launched Eaton Vance Bond Fund, as well as co-director of the firm's investment-grade fixed income area. She joined Eaton Vance in October of last year after spending more than 2 decades at Luma Sales, where she co-managed the award-winning Luma Sales Bond Fund with bond legend Dan Fuss. I began the interview by asking Kathleen how she felt about launching a bond fund in such turbulent times.
That I might need to have my head examined. Actually, in January, it was a little bit challenging to think about, as a value investor, where am I going to find value in 2013? It's been an interesting several months, and actually it's getting a little bit easier, and in some aspects, I think rising rates make it a great opportunity for investors that can be very flexible in their fixed income allocations.
So what's the opportunity?
The opportunity is avoiding the risk. So the risk is interest rate risk. We all expect interest rates to start moving up, and that is most serious for U.S. Treasuries. That's the ultimate arbiter of interest rate risk. So every bond, however, does have some component of interest rate risk. So my job this year has been to look across the fixed income markets for bonds that offer what I would consider good corporate fundamentals without a lot of rate risk. So that means going into corporate bonds where there's a little bit more yield. There's also some rate risk there, so you do have to be careful. But looking at securities in non-US, both corporate and sovereign, and looking a little bit closer to our equity brethren, using convertible bonds, which I think is a great way to get that exposure to corporate fundamentals without taking a lot of rate risk.
You wrote a piece recently basically saying that traditional bond strategy may offer investors little protection against declining values during a rising interest rate environment. So where's the danger, and what do you mean by a traditional bond strategy that could be a real problem for investors?
When I say traditional, I'm thinking of the benchmark of government bonds and high quality corporate. Those are the bonds that are carrying the most amount of interest rate risk. And so they're really just subject to simple bond math, that as rates have come down, coupons have come down, and you still have different maturities. So as rates move back up, there's a repricing of the market.
One of the things that you also wrote to your Eaton Vance clientele was that it's probably going to be the most challenging environment that at any time in 3 decades. PIMCO's Mohamed El-Erian just came out and said, that to say that bonds are under pressure is an understatement. So I mean, how challenging is the environment that we're in? I mean, how would you characterize it?
Well, it's challenging if you're constrained to that benchmark. A great example is the recent issue in the market for Verizon.
Right. This was a record bond sale of $49 billion worth of Verizon bonds.
Twice as big as Apple.
It was oversubscribed. I mean, so here we are in a bond market that everyone, is talking about people fleeing, and yet there was this huge appetite. So explain, that kind of contradiction.
Well, for the traditional bond manager, the best way to add value is to add some incremental yield. So Verizon comes to market and they price their bonds to sell.
And they priced it to sell in that they offered a higher yield than kind of equivalent corporate credits would offer. Is that what they did? So they gave you a little bit more yield.
To incent you to buy.
Right, and so people did.
And they did.
Yeah.
And they came out 2 times oversubscribed, so a lot of demand. But what you have to think about is, if you believe that interest rates are going up, and the 10 years around 3% today.
The 10-year Treasury bond, right.
10-year Treasury bond. We're likely to see higher rates. I'd argue that we're likely to see a 4% 10-year next year. So where will that Verizon bond be trading next year? Now, if it's a good economy, it could have less of a premium. So the yield could come down relative to treasuries. But if treasuries move up 100 basis points, I really doubt that Verizon's going to be able to hold its ground that much. It's still going to decline in price. And so the only thing that's saving you is that coupon.
Kathleen, you just mentioned the word constrained. Now, you could have established any sort of a bond fund that you wanted to in launching a new bond fund at Eaton Vance, but you chose to have a bond fund that you call unconstrained. What does that mean, and why was that so important in this environment?
It's important because investors are really challenged right now to find those types of opportunities that will lead them to have returns in a rising rate environment. So flexibility to go into corporates, investment grade and high yield, to have full flexibility to go into non-US corporates and sovereigns, because that's likely to be where we see a lot of the supply coming down the road. However, for the time being, as we started out at the end of January, looking at what was going on in the global economy, I thought the US looked to be in pretty good shape. At a time when I had full flexibility to go away from the US, I really was focusing much more on the US market.
So unconstrained means basically that you can invest within certain parameters in a lot of different types of securities, in a lot of different types of fixed income securities. You also have the ability to invest in equities, stocks too, right?
I do. 20% flexibility.
Right.
With the idea that, again, for investors, they're going to be challenged, and one of the biggest challenges in a low rate environment has been trying to find sources of income. When I think about investment ideas and looking for good fundamentals, I'm really thinking across the whole capital structure. So if there is a company and it's doing something strategic and it's generating cash flow, who's going to benefit? The bondholders or the equity holders? And we're at this interesting time where balance sheets are in good shape, so we're unlikely to see bonds get any better, and yet equities have the potential to pay dividends, or at least grow their dividends. So that to me is a good source of income where there's stability of income, a great offset as interest rates start that march up higher.
When you launched the fund in January of 2013, so out of the box, you looked at the U.S. and decided that the U.S. market was pretty attractive. So what did you do? What was your strategy from the get-go?
For the most part, U.S., so looking around, what was driving the U.S. economy, where were the best values? Clearly, if the U.S. is recovering, and I have lots of flexibility, but can't quite go everywhere, looking in the investment grade area, lower quality, triple B, so still investment grade, but companies that are more cyclical, so benefiting from a recovery in the U.S.
Oh, interesting,
High yield, which is great for the yield, not as much as we've seen historically, but a great place to benefit from improving fundamentals. Little concerned that the high yield area had too much rate risk, so that problem again of bond math, the coupons are just too low to offset rising interest rates. But what I find interesting in the current market is that as the economy improves, we're seeing more and more M&A activity. So you have a number of credits that were investment grade, going below investment grade. We like to call them falling angels.
So explain how that happens. And M&A is mergers and acquisitions, and we certainly have seen a pickup in that activity. So how do you give us an example of how you take advantage of a merger, for instance?
A good example might be Dell, and not a merger, but a decision by the company to go private.
Right.
So an LBO, which
Leveraged buyout.
Leveraged buyout, which many people might think back to 2008 and think, I don't want to go back to an LBO candidate.
Right.
But think about what's going on. Interest rates are now so low because of the crisis. Leverage is way down. Michael Dell is faced with an industry that's declining. Nobody's using PCs anymore, but technology is what's driving the innovation. He wants the time and space to rework his company. The easiest way to do that is to go private. And if you think there's a good franchise there and good asset value, then there's a great opportunity where you've got bonds that still pay you a coupon, but they've declined in price. So they do have the ability to give you some capital appreciation potential through corporate fundamental turnaround.
So these are existing Dell bonds that were out there, and if you're taking a company private and he's doing it by issuing more bonds, and therefore the current bonds went down in price,
Yes.
and you look at that and you say, this is a turnaround situation, and therefore the existing bonds out there are good bonds to buy.
Exactly. You have to believe in the credit story.
Right.
And so what you're assuming is credit risk. And that is the risk that's worth taking in this market. Avoid interest rate, but look for credits, or I would call it companies, that offer good value, that are going to march to their own tune, that as interest rates move up, they're not going to be as dependent on what's the coupon, what's the maturity, the math. It's about the fundamental picture within the company itself. And there's so many changes going on in our economy right now. There are great opportunities. So those animal spirits are creating those opportunities.
So you're talking about animal spirits, but you know, when you look at what happened when Federal Reserve Chief Ben Bernanke came out in May and announced that in fact the Fed might start withdrawing some of its bond purchasing program, and everybody completely freaked out. Did you have to change your strategy when that occurred? I mean, how did you deal with that in a new fund?
I really didn't, because being a long-term investor and recognizing that the trend did seem to be positive, I think the Fed has done a really admirable job, and it is a good sign that they're willing to taper, that it means the economy's in good shape. I'm positioned for that recovery, so I'm really sitting tight and looking at how the individual companies are managing through this time horizon. I want to hold on to bonds for as many years as I can. Not necessarily to maturity, but that's a way of earning that income and avoiding some of the volatility that will take place as interest rates move up.
So let's talk about some of the other kind of non-traditional approaches that you're taking, and you mentioned convertible bonds, and I know preferred stocks is something. So just talk to us about some of those opportunities as well. Again, in alternative strategies.
The great thing about multi-sector is that it's a large investable universe. So you're not constrained. You're really pushing beyond the boundaries, looking for where those opportunities that a lot of the market isn't paying attention to. So convertible bonds are somewhat neglected because they're a hybrid, a little bit equity, a little bit bond. That is a good thing when it looks like the value proposition between treasuries, looking at treasury yields relative to dividend yields, is so attractive. So I want to capture that equity upside, and a convertible bond will allow me to do that. It's also a great way with high yield exposure. Again, a little bit concerned about the rate risk there, so convertible bonds are a way to diversify away, get exposure to sectors of the market that typically don't issue in the high yield market because it would be so expensive. And I'm really thinking about tech companies here.
So for instance?
For instance, a good name here would be Intel. Large cap company, lots of potential. There's upside there. Now that's a high quality company.
But they've issued convertible bonds which are convertible at a certain price into stock. Is that right?
Into stock.
Yeah.
And so it tracks the price of that stock to a very large degree. On the below investment grade side, another tech company would be something like a Ciena. So that's telecom equipment. All these iPhones that we're buying and the semiconductors and the networks that need to be connected, it's all a part of what's moving the economy. And this is a sector that's lagged tremendously because the large corporations that typically buy from them haven't been spending, but we see that pick up in spending coming very soon. So that's a way to get exposure to a segment of the market that is high yield that we think has better upside potential.
So you're doing, in-depth homework, right, on the individual issues that you're buying. This is not like buying a sector, or you're really doing it one security at a time.
Focused on those corporate fundamentals.
Right.
And so I'm very fortunate to be working with a great team in Boston that helps identify those great long-term opportunities.
So, one of the things that I remember when you were at Loomis Sayles, and co-managing a much larger bond fund and a very, in a long established bond fund, was that you were investing in, emerging markets, in local currency bonds. You were, local currency government debt of emerging markets, and you were looking at currencies as well. So what are you doing in the emerging market space, which has really been hurt during this, period, the last several months?
Great point. It's an example of where tapering, which I view as positive,
right,
has not necessarily been a positive. And I've been focused on the U.S. for just that reason, that when we started out in January, looking at the global landscape, the yields were very low in emerging markets. And it did seem that as interest rates move up, that's not necessarily good news. Partly because rates are moving up here in the U.S., but because the fundamentals have started to erode. Think back a year ago, and everyone was worried about the developed world becoming submerged. And here it is the U.S. that's really leading everyone out for a stronger global economy. I do have concerns about the emerging markets. They're adjusting to slower growth. They've still got good growth, and I still think there's a wealth of opportunities here. But I think investors need to be much more cautious in terms of not buying in emerging markets simply because they've been growing very fast. That reminds me a lot of the housing market here in the U.S., believing that the fast growth is sustainable forever. It's not, and I think what will separate the wheat from the chaff is countries that do have good economic policy, fiscal and monetary reform, to withstand a stronger U.S. And higher rates, because in the long run, they benefit from a healthier U.S.
Now, this is actually a theme that we've just talked about with some other guests. That's very interesting to me because at one point we were saying that China, for instance, was replacing the U.S. As the driver of economic growth, and there seems to, it's that you've picked up on that same point. So in the emerging markets, has the sell-off in the emerging market debt created any opportunities? Are there countries that you look at and that you say, something, I believe in their credit quality, and in their currencies, and I think there's going to be a turnaround potential there.
I think there's a very clear opportunity on the horizon. There are benefits to being small and there are challenges. So being a small bond fund, I've got to be very patient about when I enter into those markets. It would be very easy to fill a position when you've got lots of people exiting. And so I think we all need time to sort out where are the countries that do have the good policy. And it's possible that this could be a brief sell-off. But when I look at the fundamentals in India and how difficult it is going to be for them to get on the right policy track and issue debt, that could create some hiccups in the market. So I'm being patient, but recognizing that there will be fast growth and good opportunities, but it's important to sort it out ahead of time.
Now, one of the countries that you and I had talked about a week ago was Mexico. So what's the story in Mexico? Is that an attractive, attractive for bond investors, the Mexican government bonds? Or?
I do like Mexico right now, and two good reasons why. In contrast to India, here's a country that has really come through with reform. We've watched this nation for a very long time. Corruption with the drug cartels, just very, very difficult, even though they were benefiting from growth. And here you get a new leader in place that's really able to put through solid reforms. That's a big positive. And at the same time, still levered to a growing U.S. economy.
Right.
So it has both represents the ability to benefit from a stronger U.S., but it also represents a good citizen in the global economy and the types of countries we want to continue to identify.
So, with the flexibility you're talking about in the Eaton Vance Bond Fund, so if you had to pick one investment, as you know, we always ask our guests at the end of a wealth track or close to the end of the wealth track, what would the one investment be?
So the one investment, and it's really hard to pick just one.
Right.
But I'm an optimist by and large, and I'm a fixed income manager, so I'm going to go a little bit off the edge to an area where I think there is a good opportunity. I've talked a little bit about it already, just in the tech sector, and that's applied materials. So part of what is causing the tapering and making many fixed income investors uncertain is stronger growth.
Right.
And what I'm looking for are those corporate fundamentals, markets that are really growing in the global economy, and tech is so much a part of it. But the important part, as you mentioned about digging into the individual companies, are finding the ones in tech, because obsolescence and the product cycles are so fast. You want to identify the companies that have the right product mix. And Applied Materials is just that sort of company, growing in their industry, and we think looks like it has the ability to grow its dividend as well. This is a stock
you're talking about
from a bond manager,
right, but from an unconstrained bond manager. And my final question, Kathleen, is in the search for safe income. Is there one sector? Is there any area that does that still exist where we can find some yield and that we can depend upon? Does that exist in the bond market anymore?
It's always going to exist in U.S. Treasuries in terms of safety.
Right.
And as interest rates move up, that income rate is going to get higher. So a more conservative approach that would appeal to investors would be just laddering treasuries.
So buying different maturities, and as they mature, you buy as interest rates go up. You buy other,
and just roll back in at
into a higher rate.
So you come down the curve and then roll back up roll into higher yielding treasuries.
So interesting.
And that's a great way to protect your income.
And that's a contrarian idea. So you're saying do not give up U.S. Treasuries entirely, despite what everyone's saying about them being such a dangerous investment.
No, and there are conservative strategies that work, and it's one great reason to be a part of a team where I may be unconstrained, but we've also got the ability to manage conservative laddered strategies as well.
Terrific. So Kathleen Gaffney with the new Eaton Vance Bond Fund, thank you so much for joining us on Wealth Track. It's great to have you back.
Thanks, Consuelo.
At the end of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is stick with experienced bond managers with successful long-term track records. We are going through a major generational shift in bond market conditions right now. This is no time to be in passive index bond funds or ETFs that are completely subject to the vagaries of a volatile market. This is one of those periods when you need a steady, experienced hand at the tiller who can make decisions based on market conditions, fundamentals, and opportunities, not on crowd behavior. We are entering an era where judgment will really count. Next week on Wealth Track, we will sit down with another next-generation great investor. First Eagle Fund's Matthew McLennan will discuss why he is seeing financial fault lines around the world and how he is protecting his investors from potential earthquakes. Check out our website for past Wealth Track interviews, exclusive insights into our guests, and research from our sources on Wealth Track Extra. And please connect with us on Facebook and Twitter for Wealth Track updates, what we're reading, and more. Thank you so much for taking the time to be with us. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter.